Hi there, welcome to my channel. Thank you very much for sticking to my channel. If this is your first time on my channel, kindly hit the subscribe button down below this video and also consider liking the video if you like the content, and don't hesitate to leave your comments in the comment section if you have any issues or comments that you have to make after watching this particular video. All right, so in this particular video we are coming to look at how to prepare the statement of cash flows in accordance with IAS 7 statement of cash flows. So as you may have already realized, on my channel we have covered the single entity financial statements preparation under IAS 1 presentation of financial statements, and we have also covered consolidated financial statements. Everything you need to know to understand consolidated financial statements has been covered right here on this channel. All right. And then we also covered IAS 28, that is investments in associates and joint ventures. Those have also been covered under consolidated financial statements. So do check those videos out. Now, when we were studying IAS 1, we need to understand that the complete set of financial statements includes the statements of cash flows. All right, and the reason why the statement of cash flows is dedicated to a particular standard and not covered under IAS 1 is because statements of cash flows, unlike the other financial statements, is based on cash, okay, movement of cash. So that means that it is prepared and on the cash basis of accounting. All right. Whilst the other financial statements, which are the statements of financial position, the statements of profit or loss and other comprehensive income, as well as the statements of changes in equity, are all accrual based, which means that they contain non-cash items. All right. So those are the reasons why statements of cash flows is separate from the other financial statements. So in this particular video, we are going to dive right into IAS 7. At the end of this video, we should be able to confidently prepare statements of cash flows under IAS 7. All right. Okay, so this is the outline. We are coming to look at a brief overview of the standard, and as I already said, the standard states that a statement of cash flow is part of the complete set of financial statements. Okay, the standard IAS 7 statement of cash flows has stated that the statement of cash flows is part of the complete set of financial statements that a firm or an entity should prepare. All right, so it is not an optional financial statement, it is a requirement to prepare the statement of cash flows, and hence it is very important for us to understand how to prepare this particular financial statements. Now, why is it important? Why is cash important? What is the usefulness of the statement of cash flows? Now, when it comes to the importance of cash, cash is very important. And now, one thing you should know is that a company can be profitable. That means it is recording profits on its statement of profit or loss and other comprehensive income, but might be struggling with liquidity problems. All right, so profitability doesn't necessarily mean liquidity. All right, this is something you must take note of. Profitability does not necessarily mean liquidity. You can be profitable and yet you may not have cash. And see, one thing about entities or companies is that they use cash for their day-to-day transactions. They don't use um, the book entry profits to finance their operations. It's the cash they are interested in. So the cash flow statement is by far the most important. All right, as much as the other statements are also important, the cash flow statement is more important than the others because the firm ultimately needs their cash position, the changes in this cash, so that they will know how to determine their investing and financing activities. All right, or even to finance their operations. So that is how important the cash is. So entities need cash for essentially three reasons. Number one, to conduct or to be able to or undertake their operations. Number two, to be able to pay for their financial obligations. That means loans and all that needs to be paid with cash. Okay, and then thirdly, they also need cash to provide for the returns to shareholders or investors. All right. So when you want to pay dividend to your shareholders, it's cash you are going to pay. It's not the book entry profits that you are going to pay. It's cash. All right. So that is how important cash is. If you want to invest in a new business or you want to expand your business, it is cash you need. All right. So that is how important cash is. Now, according to IAS 7, the standard has actually outlined some uses or usefulness of the cash flow statement information to the business or to users of the financial statements. And I'm going to list some of them here. One, the first one is that it provides information that enables users to evaluate changes about their net assets, their financial structure, okay, including their liquidity and solvency, and also their ability to affect amounts and timing of cash flows. All right. Then the second one is that it is useful in assessing the ability to generate cash and cash equivalents. Users can also develop models to assess and compare the present value of future cash flows at different levels of different entities. All right. It also enhances the comparability of operating performance reported by different entities by eliminating the effect of alternative accounting treatments. And then finally, historical cash flow information can be used as an indicator of the amount, timing, and certainty of cash flows. So those are some of the usefulness of cash flows information according to IAS 7. All right. So you can just play that back and then listen to it. So those are some of the usefulness of um, the cash and then the cash flow information. Now let's look at some definitions. All right. So let's look at some definitions. Then the first one we want to look at is cash flows. So I've been mentioning cash flows, cash flows. Cash flow, we are just talking about the inflow and outflow of cash in and outside the business. All right, that is what you mean by cash flows. And then cash. What is cash? Cash comprises um, cash on hand. Okay, so when you talk about cash, you are talking about cash on hand and demand deposits. So we are talking when you talk about cash, cash is defined as cash on hand. That is the cash the business has in hands currently, as well as demand deposit. Demand deposit is just an amount in the bank which can be taken or withdrawn on demand. So whenever you need it, you can have access to it. That is also your cash. All right. So the money may be deposited in a bank account, but anytime you need the money, you can have access to it. That is what we call demand deposits. All right. Then the third definition we want to look at is cash and cash equivalents. What are cash equivalents? Cash equivalents are short term. So let me write that for you. So we are talking about short term, highly liquid assets. Short-term, highly liquid assets or investments. So let me put investment there. Investments that are convertible. So the next key term is convertible. That are convertible. So the key term here is readily. They are readily convertible to known amounts or certain amounts. To known amounts of cash. Okay, and which are subject to an insignificant risk of changes in value. So that is the meaning of cash equivalents. So this is actually cash equivalents. All right, cash equivalents. So what are cash equivalents? They are short-term, highly liquid investments that are readily convertible to known amounts of cash, and which are subject to an insignificant risk of changes in value. All right, so those are when you talk about cash equivalent, that is what you are talking about. All right, so that's a definition. They are short-term, highly liquid investments. Highly liquid means they are easily convertible into cash. All right, that's why you say they are readily convertible into cash, known amount of cash, and they are subject to insignificant risks of changes in their value. So that is cash equivalent. Now, we when it comes to cash flows, they are usually grouped into three. Okay, they're usually grouped into three. We have cash flows from operating activities, we have cash flows from investing activities, and we have cash flows from financing activities. Okay, so that is what we have. So you are going to look at them one after the other and look at how they are. All right, so the first one is operating activities. Okay, so when we talk about operating activities, we are talking about principal revenue generating activities of the business and other activities which are not investing or financing activities. All right, so those are operating activities. They are the principal revenue generating activities and other activities which are not investing or financing activities. So those are operating activities. All right. Now, what are some of the methods of presenting the operating cash flows from operating activities? So there are two methods of presenting cash flow information from operating activities. We have one, the direct method, and then two, the indirect method. So even though the standard permits the use of any of the two methods, all right, now remember these are the methods of presenting methods methods of presenting cash flows, cash flows from operating activities. Methods of presenting cash flows. So let me quickly correct that. So those are the two ways of presenting cash flow information from operating activities. All right. So you have the direct method and the indirect method. And I said that even though the standard IAS 7 permits the use of any of the two methods, the indirect method is the most commonly used method. And this um, pro forma statement of cash flow you are seeing here is based on the indirect method. All right, it's based on the indirect method. So that is it. Now, what's the direct method? Let me just talk about it, but we are not going to dive into its practical aspects. So the direct method, what you are saying is that it calculates the cash flow from operations by calculating cash received from customers, cash paid to suppliers, employees and other operating expenses, and then deducting tax and interest expenses to arrive at the net cash flows from operating activities. So that is what the direct method is. So we will pick our cash flows from customers, we will cash received from customers, cash paid to suppliers, cash paid to our employees, cash paid for other operating expenses, and then we will deduct the tax and then interest expense to arrive at the net cash flows from operating activities. So that's the direct method. Now the indirect method is um, what we have presented right here. So these are some of the things that we have under the indirect method when it comes to operating activities. So what we do is that we start with our profit before taxation, and then we do adjustments for depreciation, investment income, interest expenses, and then we are going to get an amount. So let me bold in that. Then we'll get this figure called operating profit before working capital changes. All right. So then we will look at our working capital. Working capital, we already know includes what? Our trade and other receivables. We have our inventories and then our trade payables. All right, and other current accruals and all that. So that is what we have, or receivables. All right. So that is the what we do. And then after adjusting for the working capital changes, we will get what we call cash generated from operations. And then we are going to look at our interest paid as well as our income taxes paid. And this will give us net cash from operating activities. All right, so that is it. Then the second one, the second form of cash flows that we have is the investing activities, cash flows from investing activities. Now, what are investing activities? They are those cash flows from acquisition and disposal of long-term assets and other investments not included in cash equivalents. Very important. They are what? The acquisition, cash flows from acquisition and disposal of long-term assets and other investments which are not included in cash equivalents. All right. So those are our investing activities. Now, unlike the cash flows from operating activities where we have methods of presenting it, the other ones they don't have any alternative methods of presentation. So, from when we talk about the cash flows from investing activities or cash flows used in investing activities, we are talking about the principal items that come here include purchase of property, plant, and equipment, that is non-current assets, their sale, okay, proceeds from the sale of property, plant, and equipment, interest received from investments, and then dividends received from investments. All right, those are also put there. Then after you have done all of that, now purchase of property, plant, and equipment is a negative figure here because it is an outflow of cash. Now, the statement of cash flow is presented in such a way that apart from the reconciliation that is done here, all right, to arrive at operating profit before working capital changes, every um, item that results in an outflow of cash is presented as a negative figure, whilst any item or change that results in an inflow or increase in our cash position is presented as a positive figure. All right, so that's the reason why you are seeing that some figures are in negative and others are in positive. So when you look at purchase of property, plant, and equipment, you are using cash to purchase our PPE, and therefore it is an outflow of cash, and that's why it is presented here as a negative figure. Then proceeds from the sale of equipment is an inflow of cash, therefore it's a positive figure as you can see there. And the same applies to the others. So when we do all of this and we add everything together, all of these four items together, we might have a figure here which can be positive or negative, and that is the net cash used in investing activities. All right. Then we'll have cash flows from financing activities. So that's the third one. All right. So what are the financing activities? We are talking about cash flows that result in changes in the capital structure, okay, or the size and composition of equity capital and debt finance. That is the capital structure. So cash flows that result in changes in the capital structure of an entity is presented under our financing activities. All right. So when we come to the pro forma here, cash flows from financing activities, we are talking about proceeds from issuance of share capital. All right. So when you issue shares, the cash you received after investors have bought the shares, that's what we are calling proceeds, and that is an inflow of cash. We have proceeds from long-term borrowings. All right. So when you borrow money, it's an inflow of cash, and hence it falls under your financing activities. And then dividends paid. All right, dividends paid is also a financing activity, but there is a caveat. Now, the dividends paid can also be shown under your operating activities, cash flow from operating activities. All right, so you can put your dividends paid here as well. So that is the flexibility that the standard has given. That dividends from or dividends paid, all right, dividends you have paid to investors in a company can be presented under your financing activities, which is the most common one, or you can also, as an alternative, you can also present it under your cash flows from operating activities. So when you add everything together, because it's a payment, it's also an outflow of cash. So when you put everything together, you should get your net cash used in financing activities. Then you are going to put your net cash from operating activities, net cash from investing activities, and net cash used in financing activities together. And that is going to give you the net increase or decrease in cash and cash equivalents. Then you are going to add your cash and cash equivalents at the beginning of the period, all right? And that is going to give you your cash and cash equivalents at the end of the period. All right, so that is how the statement of cash flow is presented. Now, that is principally everything you need to know about the statement of cash flows. All right, so enough of the talk. Let us dive into the calculations and see how this is presented in um, in a scenario. All right, so we have an illustration here, and we are going to dive right into that. So let's look at the statement of cash flow. Now, there's cash flow statement, as you should know, is prepared from the statement of financial position and the statement of profit or loss and other comprehensive income together. So we use information from these two financial statements to prepare the statement of cash flows. All right, so that is what we usually do. So to make this easier for me, let us look at the statements of financial position, or the question here, the illustration here, and then we'll see how we are going to deal with it. We are going to use every information here to prepare the statement of cash flows. All right, so the financial statements of Hollywood are given below. So this is actually the statement of financial position. So we are giving the comparative information. So this is the current year, September 2020 X3, and then this is the previous year comparative information. So we have non-current assets, property, plant, and equipment only. We have current assets. Under current assets, we have inventory, trade receivables, interest receivable, investments, cash in bank, cash in hand. So that is for our current assets. Then we'll come to capital and other reserves. Then we have under that we have ordinary shares of 50 cents each, share premium, revaluation surplus, and our retained earnings. All right, and then under non-current liabilities, we have 10% loan notes and 5% loan notes. Then we have our current liabilities as well. The current liabilities includes bank overdrafts, trade payables, income tax, and then accruals. All right. Then that is our statement of financial position. Then we come to our statement of profit or loss. The statement of profit or loss is presented for only the current year. Now, the reason why the comparative information has been given for the statement of financial position, we are going to know in a moment. Now, the statement of profit or loss for the year 30th September 20x3, we have our revenue, we subtracted our cost of sales to obtain our gross profits. Then we have administrative expenses, distribution costs, profit from operations, we have income from investment, finance costs, and then we have our profit before tax, we less our income tax expense, and we have the profit for the year. All right. Now, if you want to learn how to prepare these financial statements, do check out my um, video on how to prepare the statement of um, the financial statements in accordance with IFRS in or on this particular channel. All right, so I'll leave the link to watch the video in the video descriptions, so you can go there and watch it. All right, then we have other comprehensive income for the year in the 30th September 20x3. We have profit for the year. We have other comprehensive income, that is gain on property revaluation, $50 there. Then we have our total comprehensive income for the year. Then we have additional information. The first one is saying that on 1st October 20x2, Hollywood issued 60,050 ordinary shares at a premium of 100%. The proceeds were used to finance the purchase and cancellation of all its 10% loan notes and some of its 5% loan notes, both at par. A bonus issue of 1 for 10 shares held was made on 1st November 20x2, right? All shares in use qualified for the bonus. The second additional information it says that the current asset investment was a 30-day government bond. The current asset investment was a 30-day government bond. 3. Property, plant, and equipment include certain properties which were valued in the year. All right. Note number 4 says property, plant, and equipment disposed of in the year had a carrying amount of $75,000. Cash received on disposal was $98,000. All right. The fifth additional information is saying that depreciation charge for the year was $87,000. The accruals balance includes interest receivable of $33,000 at 30th September 20x2 and $6,000 at 30th September 20x3. Then the last additional information is saying that our interest and interim dividends paid during the year were $53,000. Now, to prepare the cash flows, statements of cash flows for the year and analysis of cash and cash equivalents. So our focus is actually to prepare the cash flow statement. So let's look at how we are going to deal with that. Now, as I always say, when it comes to using Excel to prepare all of these financial statements, what you need to do is, first of all, you need to present the pro forma financial statement. So I'll come here to my first slide. And what I'm going to do is to copy the pro forma financial statement here. So I'm pressing Ctrl and Shift together. I can copy everything here. Copy this. And I'm going to come to the illustration tab, paste it right here. But to paste it, I'm going to use the drop down here. And I'm going to select keep source columns with width. So I'll select that, and then that has been copied down for me. So all I have to do is to add a heading. All right, so we have Hollywood statement. So we have statement of cash flows for the year ended 30th September 20x3. All right, then I'm going to bolden that and also increase this to 14. All right, so that is it. And then let me actually insert space there. All right, that's great. So with this pro forma, all I have to do is to insert the figures. All right, insert the figures, and then I'll also create a column for my workings. All right, so there are going to be workings. Some of the figures you are seeing are not going to be straightforward, so we'll be having some workings there. All right, so let me just bolden that. Okay, so let's get started. The first item on, now as I said, this is cash from operating activities. Now with the cash from operating activities, we are using the indirect method, and the indirect method, we will pick our profit before tax, and the profit before taxation is found on the statement of profit or loss. All right, so I'm going to scroll down here and pick that information down here. So that information is profit before tax 290. All right, so I'll have 290 here, and we are going to have what adjustments for depreciation. Now in the notes, I'm going to leave the question in the comment description so that you can download it and follow along, so that I don't have to be going up and down for you to follow what I'm doing, so that you can actually follow exactly what I'm doing. So I'm not going to be moving up and down All right, so what you are going to do is I'll leave the question in the description for you, in the video description, so you can also follow along. So we have been given depreciation in the additional information, that is notes. So let me just check that out for you. So that is actually note 7, I guess, note 5. Depreciation charge for the year was 87,000. Okay, so we are going to adjust for the depreciation. Now, depreciation was subtracted to get our profit before taxation. So what you are going to do is that you are going to add it back. And the reason why you are adding it back is because it is a non-cash item. With the cash flow statements, we are only looking at the cash components of our items. Okay, and that is the reason why it is so important, because whatever we are looking at here is actually the inflow and outflow of cash and cash equivalents only. Every non-cash item will be eliminated. All right, that is why you are adding back our depreciation. So the depreciation we are told is 87. Sorry. So we have been told that our depreciation is 87,000. Now these are in thousands. All right. So let me just put my thousand separator there, and then let me also put it here as well. 1,000. Now every figure here is in thousands. So that's my depreciation. Then investment income. Okay, income from investments from the statement of profit or loss again has been added. So this is our income from investments and it's $5 or 5,000. So I'll come here and I'll put my 5 there. All right, but remember it was added. It was added to obtain our profit before tax. So I'm going to subtract it. So I'll have my negative 5 there. Okay, now there's a way of turning this into brackets. That's what we do in accounting, and I'm going to do that in a jiffy. Then we have our interest expense. Our interest expense in the statement of profit or loss was also subtracted to gain or to obtain our profit before tax. So I'm going to add that one to back, and that is 19. Okay, then there is an extra item here. There's an extra item before that, and that is, it is not actually part of our pro forma financial statements, but that is income, or that is going to be profit from disposal of NCAs, that's non-current assets. Okay, and that I'm going to do a small working there. So we are talking about our profit from disposal of NCAs, and this profit is a non-cash item. So what we are going to do is that we are going to eliminate it from our books. Okay, why are we going to put it? It's going to be a negative figure. Why is it going to be a negative figure? Because it was recorded as an income in the statement of profit or loss. Okay, it's going to be recorded as an income. So since it's an income but it's non-cash income, we are going to subtract it from our profit before taxation. It has been included here as a positive figure, so I'm going to eliminate it. So how do we calculate that? Let's go to the notes and see how that is the information there. So we have been told that property, plant, and equipment disposed of in the year had a carrying amount of 75,000. Okay, but the cash that we have received on its disposal was 98,000. So what's the profit? This is the amount we sold it for, but this is the amount it's actually worth. So the difference between the amount it has been sold for and the carrying amount is the profit amount. So that is going to be on 98 minus 75. I'm going to put that in brackets here, and I'm going to do that calculation again. 98 minus 75, and then I'm going to put a negative figure around that. Sorry, so I'll put this in brackets. So let me wrap it with a bracket here, and that is going to give me negative 23 there, and this will give me all of these added together, including the profit before taxation, is going to give me the operating profit before changes in working capital. Okay. So we have this, we'll have this plus everything here, and this, and then we have 368. All right, so that is the operating profit before changes in working capital. Now, what are the working capital? The working capital, as we have seen, are the current assets items here. So we have inventory, trade receivables, as well as trade payables. Those are the principal working capital items that we have. Okay, but there might be other ones. So we have the first one here. Now, this is just a pro forma, so we are going to change it as and when it is necessary. So we have increase in, so instead of using increase or decrease here, you can only know if it is increasing by looking at the comparative information. Now remember, this is the old figure and this is the new figure. So let's look at the first item here is the receivables. So let's look at interest receivables, trade receivables here. So our trade receivables, we are saying that it is what? At the beginning of the period is 320, but the current year is 390, which means that it has increased. Okay, so the increase here is appropriate for it. So what do I have here? I'll have equals, and whenever our trade receivables are increasing, it means our cash is reducing. Okay, because our customers or those who owe us are not paying us. So that is actually a drain on cash. That's the meaning. So whenever trade receivables are increasing, it means, or whenever there is an increase in trade receivables, it means we are what? Less on cash. Customers are not paying us. That's the implication. So what do we have? We will have 390. I'll have 390 and less my 320, and this is an increase and it's a decrease on cash. So I'm going to put it as a negative and wrap this around with brackets and have that. So that's negative 70. Then we have inventories. So let's look at our inventories. Is it increasing or decreasing? This is what we have at the beginning of the period, and this is what we have at the end. And this is a decrease in inventory. Now, whenever our inventory is decreasing or there's a decrease in inventory, it means we are selling our inventories for cash. So it means our cash has also increased. So it's an inflow to us. All right. So whenever there is an increase, so this is actually increase in inventories. Sorry, this is a decrease in our inventories. Okay. So whenever our inventories are decreasing, it means we are receiving cash or we are selling them for cash. That's the implication. So what do we have there? We'll have 460 minus 420, and that is 40. All right. Then the next one is also trade payables. Now, trade payables is under current liabilities. So let's come to my current liabilities here. What is happening to our trade payables? At the beginning of the period, we had 400. At the end of the period, we are having 550, which means it has increased. And increase in payables means that we are not using our money to pay our suppliers. Therefore, we are holding on to the cash. And that means that our cash is increasing. All right, so that is the meaning. So when we come here, we are saying that at the beginning of the period, at the end, it was 550. At the beginning, it was 400. Okay, so it is increasing our cash position because we are not using the cash to pay our debts. The debt we have owed our suppliers. All right, so that is 150 and it's a positive figure. Then there is another current liability item they called accruals. Okay, so we have to look at that. So it means we have to insert another item here, which is also a working capital item, which is accruals. So I'll come here and say change. Okay, so let's look at it and see whether it is increasing or decreasing so that we can actually know whether it is an increase or decrease. Okay, so from here it is an increase. Okay, but we have some additional information relating to this particular item, accruals. So let's look at the additional information and see what is there. So they are saying that additional information 6 is saying that the accruals balance includes interest payable of 33,000. So included in the accruals is interest payable of 33,000, which is a different item. Okay, so I have to subtract it. And another one of 6,000. So this 33,000 is at the beginning of the period, while 6,000, another 6,000 at the end of the period. So this is what we're going to do. We're going to do a small calculation here. So our workings one is going to be accruals. So what do we have? We will have, let me go up there and copy this. And paste here. All right. So what do we have? We are going to have the balance brought down. Okay. So per the statement of financial position, our accruals balance at the beginning of the period is 33. All right. But we have been told that this includes an interest payable of 33 as well. So I'm going to subtract that. And so the balance for our accruals is actually 0 at the beginning of the period. Do you get that? Then you have also been told that at the end of the period, okay, at the end of the period, which is balance carried down, CD, at the end of the period, we had an accruals balance of 36, okay, but included in this is interest payable carried down of 6,000. You can read the additional information again of 6,000. So that means that our interest or accruals at the end of the period is actually 30. All right, and that is the balancing figure there. So let me wrap that around with borders. Okay, then the difference between these two figures is what we have actually we can actually classify as increase. Okay, so now we have determined the beginning balance of 0 and the closing balance of 30. So what is the difference? So if we had 0 at the beginning of the period and now at the end of the period we have 30, it means our accruals has increased. Okay, by what? It has increased by 30. So I'll just have my ending balance and subtract my opening balance, and that will give me 30. And this is our increase in accruals. Okay, and that is actually the balancing figure right there. Okay, so that's our balancing figure there, 30. So quickly, I'll come here and I'll have increase, come here and have increase in accruals. And that is what? 30, as you have already calculated. So now that we have gotten all these figures, we can add everything together. We can add everything together to obtain our cash generated from operations. Okay, so I'll just have alt equals to add everything there, but it's actually from here. So I'm going to add everything there together, and that will give me 518. So that is our cash generated from operations. Then after getting that, I'll have my interest paid and income taxes paid. All right, the interest paid and income taxes paid. But when it comes to these interest and income taxes items, we need to do some workings as we have done for our accruals, because they have more than one figures relating to those items. So the first one I'm going to do is interest paid. We are looking at the cash interest paid only. Okay, the cash interest paid only. The interest paid potentially has non-cash items, so we are going to eliminate the non-cash items and look at only the cash items. So what is the beginning period of our interest? Okay, so we are going to interest paid when we look at the information, we have been told that additional information, we've been told that our interest payable balance at the beginning of the period, that is 30th September 20x2, is 33,000. All right. And then at the end of the period is 6,000. So I'm going to put that right into our calculation. So we have balance brought down, and that is 33. And then I'll come here and put balance carried down, and that is 6 right there. Okay, then what happens? We had a finance cost, okay, that is interest, in the statement of financial profit or loss, statement of profit or loss. So let me go to my statement of profit or loss here, and we are saying that there is a finance cost of 19. So this finance cost of $19,000 is actually an interest payment. Okay, that's the interest you have paid on the loans we have actually taken. All right. So when it comes to the calculation for interest paid, this finance cost is going to be included in calculating our interest payments. Okay, our cash interest payments. All right. So what's the finance cost there? It is 19. So I'll put it right there. Okay. So now that we have gotten these figures, what we're coming to do is to now find how come we got this balance of 6. Okay, and that's exactly what we're coming to do, and that balance becomes the cash payment for our interest. Okay, so how do we do that? At the end of the period, our interest balance, okay, the interest paid balance is 6,000. So let me put that there, right there. And now we are saying that at the beginning of the period, this is how much we had as interest. This is how much we have actually paid as our finance cost in the statement of profit or loss. So how do we get the missing balance? So the balance here is going to be what? This particular figure here minus the addition of these two figures. So I'll have plus this again. Okay, so this is what we're coming to do. Let me just enter this, delete that. So what we are saying is that I'll pick my balancing figure, which is equal to this, and then I'm going to subtract these two figures. Okay, I'm going to subtract these two figures, and that is going to give me 46. So that is my interest paid. All right, now this particular figure here or this particular calculation here can also be done alternatively using T accounts. Okay, so that's the balancing figure there. So let me just close it. So this particular calculation here we have done can also be done using T account format. So using a T account format, since interest is a liability, okay, this balance here is going to be displayed on the credit side of the T account as balance brought down. The finance cost, which is on the presented as an expense on the statement of profit or loss, will also be at the credit side of the interest paid accounts, and then the balance carried down will be at the debit side of the interest paid account. Then the balance here will also be at the debit side. Okay, so that's how you prepare the interest payments account. If you want to learn more about double entry and all that, you can check out my other videos on double entry systems. Okay, on how to automate accounting recording system, bookkeeping systems. Okay, I have that on my channel, so you can check it out. All right, so but this one we are looking at the column, the calculation in a columnar form, and I think this is much easier than the T account, which is also easy, but this is much easier or much understanding. All right, so that's how we calculate our interest paid. Now, quickly let's do our income tax paid as well. So we have income tax paid, and that is also presented similarly to the interest payment. So we will have our balance brought down. Now, tax can be current tax and deferred tax. When there are two taxes, current tax and deferred tax, we add both of them together to obtain our balance brought down at the beginning of the period. Okay, but here, just income tax, we don't know whether it is deferred, but this is under current assets. So this is current tax liabilities. So at the beginning of the period, which is the comparative figure here for 20x2, the amount is what? 90. All right. Then we paid tax in the statement of profit or loss. So tax paid. Tax charge. Okay, it's rather tax charge for the year inside the statement of profit or loss. So let me just check that. So our income tax expense is 104. So I'm going to add that to the beginning figure right there, 104. And then at the end of the period, our tax liability is 100,000. So I'll have here balance carried down, and that is 100. Okay, and that is the balancing figure. So I'll put that around that. Then the balancing figure, which we are going to calculate just as we have done for interest paid, is going to be the closing balance or the balance carried down minus these two figures. And that is going to give me $94 there, 1,000. And that is our income tax paid. Okay, and that is our balancing figure. Okay, so now that we have obtained these two figures, we can go ahead and insert them into our statements of cash flow. So what is the interest paid? It is negative 46, and then our tax payment is also 94, which is also a negative figure. So if I add these three figures together, adding these three figures together will give me my so I'll come here, half equals the sum of these three figures together. All right, so the sum of those three figures together, and that will give me 378, and that is the net cash from operating activities. Okay, that's our net cash from operating activities right there. And let me also insert another border here. All right. Okay, so that is it. Then let me also bold this amount. Then that is it for the cash from operating activities using the indirect method. So let's continue to cash flows from investing activities. So the investing activities, we are talking about purchase of property, plant, and equipment. Was there any purchases of property, plant, and equipment? We have to do a calculation for it. Okay, and that is what we also call capital expenditure or capex. Okay, so let's go to our workings and see whether we have purchased any property, plants, and equipment. So purchase of PPE. So what is the balance of our PPE at the beginning of the period? That can be found on the statement of financial position. So let's come here. Property, plant, and equipment at the beginning of the period was 510. At the end of the period was 634. So this is 510 at the beginning of the period. So this is actually balance brought down. Then I'll come here and do balance carried down, and that is 634. Okay, so that is how we start with it. Then what happens? In the additional information, we have been told that there has been a revaluation of assets. So let's just look at that. So let's look at that. Property, plants, and equipment disposed. Okay, property, plants, and equipment include certain properties which were revalued in the year. This revaluation value has not been stated in the additional information, but information on revaluations is presented in other comprehensive income. So let's come to the other comprehensive income here. So we have statements of other comprehensive income, and then we have other comprehensive income, including gain on property revaluation. So this is a gain. Okay, it means it's an upward revaluation. So I'll come here and write revaluation. So this is how you calculate for any addition to your property, plant, and equipment or your non-current assets. All right. So what's our revaluation is 50, and since it's an upward revaluation, it's going to be a positive figure. If a downward revaluation, we would have make it a negative figure right there. Okay. Then the next item we want to look at is if there is any disposals. Okay. And we have already established that there has been a disposal of property, plant, and equipment. And how much did we dispose of the property, plant, and equipment is 75,000. Okay. Disposal, we are picking the carrying amount of the PPE disposed, only the carrying amount. All right. So take note of that. So I'll come here, and then the carrying amount is 75,000. The next item we will look at is depreciation. And we've been told that in additional information that depreciation is 87,000, which you have already looked at. So now that we have gotten all this information, we don't have any other information that we can include here. So let me cut this and paste here. Now that we have gotten every information here, this is our balancing figure. So let me just do it like this. So I'll have equals the closing figure, and then I'm going to subtract all of these figures. So minus this, minus this, minus this, and minus this. Now, depreciation was subtracted. So I'll come here and put my depreciation as a negative figure right there. And then also the disposal, because the property, plant, and equipment was disposed, it means it's a reduction of our property, plant, and equipment. We have sold it, so that one too will be a negative. All right. So our additions, or capex, okay, that is actually our balancing figure is 236,000. Okay, so that's the amount of property, plant, and equipment we bought. Okay, we bought during the period. So quickly, I'll come here and come and put my purchase of property, plant, and equipment there, 236. All right, so just like that, we have it there. Then we also have proceeds from sale of equipment. So how much did we sell our equipment? We have already determined that from our additional information. We sold it for 87,000, I guess, 98,000. So cash received on disposal was 98,000. So you are going to put that right here. Okay, so we have what, 98 right there. And since the purchase was an outflow of cash, you have to put it as a negative. All right. Then we have interest received. Interest received. Now the interest received is also going to be a calculation. We need to calculate the interest that we have received during the period. So how are we going to do that? I'll have my calculation here. Interest. So that is actually workings 5. Interest received. So the interest receivable presented under our non-current current liabilities. Okay, interest receivable balance brought down. So interest receivable brought down. How much was it? It is found at the beginning of the period. It is found in our statement of statement of financial position, and it is found under our current assets. So interest receivable at the beginning of the period was 9,000. At the end of the period is 4,000. So quickly, I'll come here and put those there. So this is 9,000, and then interest receivable carried down is 4,000. Sorry, so this is 4, and this is supposed to be 9. All right, then we have our finance income. Now remember, interest received is the direct opposite of interest paid. Okay, so just as we have finance costs relating to interest paid, we have finance income relating to interest received. Okay, so what's our finance income? This can be found in our statement of profit or loss. So let's look at that. What is our finance income? That is added to our that is the investment income here. Okay, income from investment, 5,000. So I'll come here, and then my finance income is going to be 5 right there. Okay, and that is the only item we can actually deal with. So let me copy this, cut this, and paste it here. So now that we have this figure, I'm going to put it right there. And what is going to be the balancing figure is going to be equal to our balance at the end of the period minus these two figures. Okay, and that will give me negative 10 there. And that is my interest, my cash interest receivable, or cash interest received. Okay, and that is actually my balancing figure right there. Okay, so that's negative 10 right there, and I'm going to put it under my interest received as my interest received, and that is negative. It is a received amount you have received, so it's going to be positive 10. Okay, it's going to be positive 10 right there. So we don't have any dividend received, so I can actually take it out. So dividend received is what? 0. Then this is going to give me the addition of everything here is going to give me my net cash used in investment or investing activities. All right, so I'll have that. So that's negative 128. All right, then we also have our cash flows from financing activities. So the first one is proceeds from issuance of share capital. So in our additional information, we have been given some information about our shares. Okay, so let's look at that. So we've been told that on 1st October 20x2, that's at the beginning of the period, Hollywood issued 60,000 50-cent ordinary shares at a premium of 100%. The proceeds were used to finance the purchase and cancellation of all of its 10% loan notes and some of its 5% loan notes, both at par. A bonus issue of 1 for 10 shares held was made on 1st November 20x2. All shares in issue qualified for the bonus. Okay, so bonus issues. Okay, bonus issues are non-cash issue of shares. They are shares that are issued not for cash. Okay, those are what you call bonus issues. So we will not deal with anything relating to bonus issue of shares. What we are interested in how much we have received for our shares that we have issued. Now we have been told that we have issued 60,000 shares. Okay, we have actually issued 60,000 shares at the beginning of the period at $0.5 or 5 cents. Okay, but this is the share, but this has been issued at a premium of 100%. So this is the share price Okay, listen to me very carefully. This is a share price, but there is a share premium. Share premium, and the share premium is also equal to what? 100% of this amount, which means that the same amount. So this is 0.5 times 100%, and that is going to give me the same amount. Okay, so at the end of the period, we have actually issued these ordinary shares at $1. That's the addition of these two. Okay, so we'll have 0.5 plus 0.5. So that is the total share price. Total share price. Okay, that's the total amount that we issued our shares. So it means that the amount for which we issued the shares, or the proceeds from the issuance of the shares, is actually 60,000, and that's 60 there. All right, and we've been told that we have used this amount to pay proceeds from our long-term borrowings. Okay, and our long-term borrowings from the statement of financial position here are actually two: 10% loan notes and 5% loan notes. But the 10% loan notes are actually zero at the end of the period. Okay, so we have 40 there. Let's look at the additional information again. The additional information one, it is saying that the proceeds were used to finance the purchase and cancellation of all of its 10% loan note. So all of it. So what do we have? It means that at the beginning of the period, the loan notes at the beginning of the period have been paid off. So what is our loan note at the beginning of the period? 10%. All of it has been paid off. That is 40 here. So I'll have negative 40 because you have paid it off. Everything at the beginning of the period. And the balance. What's the balance left? The balance left is 20. We are using this 60,000 to pay off our loan notes. So how much can we pay out of the remaining amounts of loan notes here? This 349. The only amount you can pay out of that is 20,000. Okay, so that is it. Then, so what we will do is, this is actually redemption of 10% loan notes. Okay, and then we also have redemption of 5% loan notes. Then let me insert a couple of let me insert for our dividend paid. So there was no dividend received, but there is a dividend payment. Let's go to the additional information and you will see what we mean by the dividend payment there. Interim dividends paid during the year were 53,000. So there has been a dividend payment. Now, as I said, the dividend payment, the standard has given us the alternative of presenting it under cash flows from operating activities. Okay, but commonly it is presented under cash flows from financing activities. So I'll put dividends paid there as negative 53. Okay, so that is what we have there as our cash flows from financing activities. Okay, so as I said, it is everything that pertains to our capital structure. So you see, we have shares and then loans, long-term debt and all that, then dividends as well. So I will just have a sum of all the information there, of all of these figures, close my parentheses, I hit enter, and that will give me 53. So adding all of this information, so I'm going to have this plus my net cash used in financing activities plus my net cash used or from operating activities is what is going to give me the net increase in cash and cash equivalents. This is a positive figure, so it's an increase in our cash and cash equivalent. Where it's a negative figure, then it's going to be a net decrease in our cash and cash equivalent. All right. Then what is our cash and cash equivalent at the beginning of the period? That can be found on the statements of financial position. So let's come to our assets. So cash and cash equivalent at the beginning of the period. How much is that? At the beginning of the period, we had zero cash in hand and 5,000 cash in hand, or cash in the bank was zero, and then the cash in hand was 5,000. But we also had a bank overdraft, okay, of 70. That means that the balance, the net balance, is actually going to be the bank overdraft, which is a negative figure of 70, added to the 5,000 cash in hand, okay, and that is going to give me negative 65,000 here, which is actually a bank overdraft. And then adding that to my net increase in cash and cash equivalents will give me the cash and cash equivalents at the end of the period, and that is 132. Now, this 132 can actually be verified from our statement of financial position. So before that, let me just do this. And this is actually supposed to be top and then double. Yes. So we have that this particular cash and cash equivalent at the end of the period should be equal to the cash and cash equivalent figure at presented on the statement of financial position. So let's verify that. If you do that, if you do the verification and you don't get the figure, then it means you are wrong somewhere. So what is our cash and cash equivalents here? The cash and cash equivalents include these investments here. Okay, they are current assets, so they are what? Cash equivalents. The investments here are cash equivalents. Remember the definition of cash equivalents? They are what? Short-term, highly liquid investments. So this investment at the current asset side here is a cash equivalent. So we'll have our 50 there, 50, and then I'm going to add my cash in bank of 75,000. So I have 50,000 added to 75,000, and then added to cash in hand of 7,000, and that is 132. Okay, so you can actually verify the cash and cash equivalent figure that you have gotten at the end of the period. So this is how we prepare the as you can see, this is how we prepare the statement of cash flows in accordance with IAS 7 statement of cash flows. All right, I hope you have learned a lot in this particular video. Please make sure you have subscribed to the channel if this is your first time watching any of my videos, and also please consider liking the video if you find it useful, and leave your comment in the comment section if you have any questions or suggestions on this particular video or any of the videos that you have watched on this channel. Thank you very much for your time. I hope you have learned a lot, and I'll see you in the next video.